Okay, here we are. Welcome all, really. My pleasure to be here with you again. How are you? How are you all today? Hope the market is treating you okay. Really? Okay, anyway, we are going to start talking right now about it. What is the cycle in market, right? We have several concepts and several ideas about what cyclic is. However, if you all may know, it's all the base of all the technical analysis, right? Mr. Down, so Mr. Down decided said that in his principles that are the base of all technical analysis, that cycles are important, currencies move in cycles, market has memory. I don't want to go through all of those basic concepts again, right? We don't need to repeat that much. But anyway, he designed, or all the technical analysis is based on the concept that market moves in cycles and those cycles repeats themselves, right? Whether or not we can determine those cycles and how and with which tools, okay, that's another history, okay? We can determine cycles by technicals, by fundamentals. We can talk about short, mid, long term. There are different ways of seeing the market, right? I guess that's why, at least for me, market is so attractive because you can never be bored when you trade markets, right? You can always learn something new. You can always try something new. Keep on studying, keep on moving, keep applying different things. Anyway, and regarding about cycles, right? We have the overall concepts of Elliott waves that I really don't like too much, but you know that that's the summum or the best theory that talks about measuring waves and measuring market behavior. So that principle of those waves or that theory is that, I don't know, as an example, if we talk about prices falling during a specific period of time, let's say we take our charts and we see that euro has been falling over the first 3 months of this year, and then we have the next 3 months prices. So we could determine in a very simplified way, right, that the pair moves in a 90-day cycle, right? It's a very simple concept. But everyway, however, for its way, it's not so simple to deconstruct, right? This is governed by several different factors that we are going to discuss today. When it comes to this forex market particularly, okay, whenever those waves repeat themselves, we call it a cycle. Yet, despite these cycles will not give us an entry or an exit point exactly, or understanding the cycles will not give us the perfect trade. The fact is that, as I said here, the basic knowledge about this cycle behavior of a certain currency or a certain currency pair can help us to forecast those trends, right? And that's the overall reason of why we are here. Anyway, I want to share something I forgot to say before starting the webinar, and that is that when I was educated in Forex, right, my teacher always says, think, okay? That was his basic concept. He did not tell me how to trade. He did not teach me how to combine indicators. He teach me how to read an indicator, how to read a cycle, or what that indicator means, as an example, okay? But then he required of me the exercise of using my own brain, right, and my own time to find the best combination of indicators to fit my strategy. Of course, he was there mentoring me and saying me, adjust this, adjust that, but he was not giving me the answer. He was all the time asking questions, right? With some advice in the way, but all the time making questions. So that's, I believe, it's the idea of all my webinars, okay? I just present you the tools. Try them, test them, play with them, right? Do your own analysis. That's the only way you will succeed in this market, because you can never trust in what anyone else is telling you unless you can prove that, okay? Not just me. Any expert, teacher, master, or whatever, trader, you want to call the one that it's at this side of the screen, okay? Anyway, and regarding, let's see if we can see next, okay, next, next paper, okay? I hope you can see the second one. We know that we have different types of cycles in the market, right? As I told you, short-term, mid-term, long-term, okay? That, of course, the short-term ones, and based on the fluctuations in the price, right? They are good for short-term traders, of course. And I believe that the only way, the best way of measuring this short-term intraday cycles, as I tend to call them, is just technically not with indicators, right? There's not much of science with that. However, we are going to discuss a bit how to mix the short term, the medium term, and the long term, because I do believe that we cannot stay stuck with just one idea or just one concept. We need to gather and use a lot of information when trading, right? And we need to filter which one is really important to us, okay? Being a short-term trader does not mean we have to ignore the long-term trade. On the contrary, being a short-term trader and knowing the long-term trend is one of the best things that could happen to anyone, right? At least for me. Anyway, and regarding medium-term cycles, despite here I talk about several days or weeks, the fact is that the medium term, I would say, I call the medium term, at least from my point of view, in between 2 weeks, 2 months. That's the most we can talk about medium term, right? If we are talking what's going to happen in a certain currency or with a certain cycle over more than 2 months, then we are already talking about long-term trends, right? It's not just what will happen in several years. I do also believe that our long-term perspective should not overcome the 6 months bias, the 6 month view, because and just as an example, right? Remember when all these Greek issues started past December in the Eurozone, okay? Euro was around 151, 150, right? When we start hearing about Greece. And at that point, when Euro was fluttering with 150 area, okay, we were all talking about Euro will hit 160 again, will probably break higher. And we have risk pushing, and the euro slumped to 125. And when the euro was slumping to 125, we were saying the eurozone will disappear. Euro will reach parity, and again we jump to 145 in the upcoming months. So we need to be extremely careful with any kind of long-term view. Okay, those kind of targets some gurus, experts, or traders post in your mind are not really the best idea. Forget about those long-term ideas, right? We are never going to catch a rally from the beginning to the end 100%. So it's better to trade in the middle. See, as just an example, okay, I'm talking too much today, I know, but for example, I don't know, the bearish trend we have seen all this year in dollar Japanese yen, right? I did not sell on 95 and profit at 80, right? I did not do that. But I have sold around 95, profit around maybe 94.20, and next time I traded across, maybe I take the chances when the pair did an upside corrective movement and sell around 94.60 and take my profits around 93. I'm giving an example, okay? Meaning the trend never goes straight, no matter cycles or whatever we saw. So, in fact, taking profits and waiting for retracement at certain points of the cycle or of the trend is much more profitable than just staying in from the beginning to the end, right? So think about that also today. Anyway, sorry, I'm talking too much. You know what the short-term cycle is. There's not much to add about the short-term. We are mostly a trader that we attempt to use the smallest amount of one single currency, right, to buy or sell and the other currency, okay, and speculate on the difference we can make in the movement in between those two. In many aspects, this type of trading behavior is very similar to trading in stocks, right? Where the aim of nearly all traders is to buy low, sell high, exactly the same. Okay? Um, you know that on, to trade, right? We need, of course, a broker and a platform. But what I need is that with the global foreign exchange market moving over trillions of dollars a day, the short-term trading is pretty easy, let's say, okay, to accomplish materially talking, right? It's easy to buy and sell, much more easier than stocks, okay? But again, I do believe that when it comes to short-term cycles or terminating short-term cycles, we are only dependent on indicators, right? And not much more. On the contrary, okay, when we are considering start talking about long-term cycles, right? There's a lot of fundamental data that I do believe is key for this. I will finish this slide and interrupt myself and check if you have questions or comments, okay? Anyway, as I was saying, when we come to the long-term data, right, the long-term cycle, there's a lot of macroeconomic theories, okay, that attempt to explain the behavior of the forex market. But we don't really need to worry about all those theories. The fact is that there are so many theories, right, made by economists that we can never find the two theories that really agree with each other. But what I mean, or however, it's really important to be familiar with the strongest data that could move the market and terminate or set a trade, okay? You know, this kind of data could generate some noise in the short term, probably when they are published, but it could not modify a trend in the short term. It could in the long term, right? That's why all the long-term cycles depend on this eventual data. I don't know if this disturbs too much of an explanation, right? But when it comes to interest rates, I know it's not a very interesting subject these days in the market, as we have been over almost 2 years right now with interest floods in the Eurozone, in the United Kingdom, in America. However, if you have been trading before that time, you know that you may remember that every time one bank was moving their rate, despite expected most of the times, right? We have strong jumps and strong gains in a certain currency, okay? The interest rate benchmark that is used generally as the rate set by the central bank, right? It's I believe one of the main market movers and main trend changes we have in a certain currency. The dollar has been pretty bullish over the last 6 years until they decide to start to lower the rates, right? Despite whatever we can see in the long term, right? The dollar has been much more weaker since the rate approach to the 0.025 floating we have these days than ever in the 8 years I have been trading, right? This yield curve is also a reliable basis on which to predict economic cycles and future trends in the interest rate. Considering the importance of interest rates in discriminating this currency price, I believe this is a valuable tool for a trader. So, for example, let's talk about America, right? They lower their rates. I don't know how many of you remember it, but earlier this year, at the beginning of 2010, there was a lot of speculation that America will be rising rates in the second half of 2010, right? Of course, that didn't happen. We are, 10 days away of the end of the year, and the rates are steady, and we will probably stay steady, I don't know, for the upcoming, at least for me, minimum all this 2011, right? But if you do a search web, start watching the past, or if you pay attention to this kind of data, you will take a look at a lot of cyclical analysts, had posted earlier this year comments about how long the Fed take to rise rates after the past and the latest crisis, 20 years ago. And in fact, most of those studies suggest that the America was not going to raise rates this year, but by the end of 2011, beginning of 2012. Now that we are approaching to that line time, right? It's easier to say that. But think about the ones that forecast that earlier this year, how they do that, how they were able to forecast the interest rates were not going to be touched over 2010. I do believe that is all about study cycle. What the Fed behavior was before, before in previous crisis. We have crisis every certain number of years here and there. So that is what we need to study to understand the market behavior. Okay, I will interrupt a bit. Okay, here I am. Okay, okay, I interrupt a bit the webinar. Okay, the slides to see if you have any questions or comments. Okay, and yes, Boyke, I need an assistance. And yes, R34, it is being recorded. And yeah, no, I don't really want to talk about a lot of waves, Elliott waves today. Okay. Okay. Anyway, do you have any questions or comments? Are you following me? Do you have nothing to say? Okay. If not, I will continue. Okay. Nothing? Okay. Okay. It was just an interruption to see if you were making comments. Okay. Let's go back to where we were, right? Let's hope, okay, this slide comes back. Anyway, and besides interest rates, we have GDP, the gross domestic product. I do believe that is the most objective reading of what country growth, right? And this turmoil days when we have all this growth times around all the major economies, well, it's key, okay? It's key to follow the gross domestic product of each and every economy. As longer it serves, we will know, as longer it stays low or depressed for certain country, okay, we will understand that that country's currency will also remain depressed, okay? Again, this fundamental reading, I don't know, let's imagine, okay, let's use an imagination as an example. Let's say that over the past 6 months, the gross domestic product in the Eurozone has been rising steadily, okay? So we have a positive cycle there. The euro has support over the gross domestic product and the currency should rise. Let's say that we have this December reading a very negative reading, okay? Following a good bunch of positive ones. Does that negative reading mean the cycle is over and the currency will start falling? No. The fact is that just one reading hardly affects the market, okay? We need at least another 6 months in a row of bad readings in that GDP reading, okay, to start talking about changing the cycle. That's very important because it's nothing that flip-flops one day to the other, right? It takes some time. Anyway, I don't want to extend too much about this, but I do really believe this is useful information. Hope you really enjoy it. Anyway, back regarding this gross domestic product that reflects the growth of a healthy economy, right? We have no healthy economies right now, and that's another story. Anyway, regarding inflation, okay, right now we are closer to deflation in several economies rather than inflation, which is exactly the contrary. But as soon as inflation starts growing in America or in the Eurozone, for example, that will mean our interest rate high to fight inflation, okay? So as long as inflation reading starts growing in a certain economy, like they are growing in the United Kingdom lately, right? Central banks tends to make a mark tolerance, right? I tolerate a 3% inflation and 2%, 5%. We need to be pretty aware of those levels because after several months inflation came above that reading, there's a good chance the central bank decides to consider their interest rate hike. I was really expecting the United Kingdom to be the first in move here. The fact is that this year has been pretty tough from the economic growth perspective for almost any major economy, so we did not have interest rates raised in any economy. However, as inflation, as I was saying, in United Kingdom is fluttering with the height of the level tolerated by Bank of England. So what happens is inflation keeps growing in the United Kingdom, let's say December, January, February, March. There's a good chance that will be understood as an interest rate hike. Okay? So the bearish cycle in pounds will be over, and we will be starting to see a bullish cycle in pound, either if the rates are remain unchanged, because market tends to advance this kind of data. Okay? They will be speculating that the Bank of England will start with their interest rate. I know this is not a lot of practical information, but once you get it inside of your mind and think about this on a daily basis, and when you read the reports month after month, and you continue putting this information into your brain, you will find out it's 100% useful. Okay? Now, back to employment. I do believe that there's not much to say about this. If dollar is not rising strongly across the board, despite the growth is steady according to the Fed, it's just because of the bad employment situation America has. Okay? So this is at least this for one that I have posted as first. I do believe are the only real important data we have to consider when trading long term, and how they weight in a currency behavior over time. Okay? Of course, in addition to these factors, there are heaps of economical and political factors like wars, elections, financial crisis, like the ones we are living right now in Europe, okay, that will probably affect deeply the forex market, okay? It's not a schedule about that. This data is not scheduled. But I do believe that if we set aside current December behavior in the market, and that's not something I will continue with, if we set aside current December behavior in the market when we have thin volume, low liquidity, and investors losing interest in trading ahead of the Christmas Eve and New Year's Eve, if we set that aside, I believe that the euro holds bearish perspective because the financial woes in the eurozone are so heavy that there's a little chance of the currency overcoming that. Okay. However, if inflation starts to grow, employment improves, we have growth there, and we start speculating over interest rate hike altogether in the eurozone, which is far from sight right now, then that should be euro supportive. Okay. Anyway, how can we use all this information? Okay. I believe that I can give you some useful tips to use to make this more material. I tend, or at least at the beginning of my trading, I was keeping a note about what was happening in the market, right? An economic calendar handy that lists indicators and when they are going to be released, and that's first, of course. And of course, I tend to keep an eye on the future also. Okay, see what the market is expecting for certain data over the coming months. And that is something you can read in news and not in calendar. But take notes of at least this for first report for major economy. We don't need to know the gross domestic product of all the countries. I do believe that main focus of attention should be placed in the Eurozone, United Kingdom, and America, right? Because, for example, data in Japan is barely followed, okay? Japanese yen is at 15-year high or barely above it, 400 pips above it, despite their general growth and situation is terribly bad, okay? Anyway, be informed about these economic indicators, okay? And which one are capturing the market attention at a certain time. Right now, we have no inflation readings, as I told you, back in the United Kingdom. So, will the market be aware or be considering taking a look at what's going on with inflation in the United States? That could change the cycle of the dollar right now? No, it can't, okay? It can't because inflation is low. We need several months of positive or strong inflation to talk about a change. So, for now, inflation is out of the focus. right? In the contrary, inflation could be in the positive United Kingdom. Okay? You know that these indicators are usually the catalyst for lashes price and volume forward. So keep an eye on them. And of course, knowing the market expectations for the data is also important. I was thinking about this yesterday when we have retail sales in the United Kingdom. You know, retail sales in the United Kingdom, in fact, grow on monthly basis 0.3%. Expectations were a bit above that level. So all the calendars were showing a red number, 0.3 as red. Okay, market was expecting 0.5. The fact is that retail sales has been growing steadily in the United Kingdom month after month. So how we consider that data so negative? It's not really negative, just because it's a bit below expectation. Retail sales have been rising 1.1% over this on a yearly basis in the United Kingdom. So in fact, it was pretty positive when it was released. And if you take a look at charts, despite the red in the calendar, okay, pound rose a bit when this data was released, okay? But anyway, keep an eye on that, okay? We should not need to take a look at the calendar and see, oh, red, positive, green, negative. That's the worst thing you can do, okay? Don't react too quickly to the news. I believe that's the best and overall advice I'd also give to myself, okay? Sometimes numbers are released, and we saw spikes to one side or the other of the market, okay? Sometimes data is misunderstood, and again, we see spikes one or other side of the market. It's the best idea of all. Given the market 15 minutes, maybe 2 candles, 15 minutes, okay, to define the trend. I always tell you, I usually wait the first 15 minutes candle, let it be, okay, and wait to go to the upside or to the downside once that first candle, higher or lower, are broken, right? That will be a way to understand how the market behaves, right? In the short term, I mean. But don't react too quick to this. Remember also that monthly readers are reviewed. For example, I don't know, employment could be reviewed, right? When we have January data, payrolls in America, we will probably have a review of what happened in December, and that also weighs on the market. So that's why it's not a short term. It's not. I mean, what I'm trying to say here, that's why we need at least 6 months of data, okay, to talk about a trend or a cycle in the economy. Anyway, another interruption, okay, and we are going to talk a bit about something else that I really like about this. Anyway, can you hear me? Does it sound okay? You are so silent, so quiet. Okay, it's everything okay. Are you all alive? Okay, you are. Okay, thank you, Ava. Thank you. Okay, you are good. Great. Okay, I was a bit scared. I would say I'm talking to myself. I'm alone here. Anyway, that's not you, of course. Anyway, another way to take a look at cycles, and I love this one, okay, is to see the behavior of a certain currency pair in a certain month of the year, right? This is an example of dollar Japanese exchange price activity in July since 2009 to 2009. 10 years of activity in here, telling us what? Okay, telling us what? Now, despite exceptions, price tends to rise over July, right? I know this is something we need to take a look at. In fact, I have made studies about this for euro and yen for almost every month of the year, okay? And we have certain months that are more cyclical than others when we see more patterns, right? Or more chances to see it rise or fall. There are months that we have one. For example, if we choose February, okay, it's a month that railroad has no statistic because one it could be positive, negative, but we have a 50-50 average chance, right? So in this particular case, you can see that in the dollar Japanese yen tends to rise strongly during July. I believe that this dollar Japanese yen is one of the strongest examples of seasonality in the market. You know, I choose this one because I believe it's the strongest one. But there are some things to talk about euro. This is the best one to talk about it. Okay? In it probably you will find out that in the studying monthly behavior in dollar expansion, you will find out that 80% of the cases the pair tends to accomplish and go with its seasonality, meaning it's very common to see Japanese yen rising in July. Like, of course, it's very common to see dollar Japanese yen falling in February and March, right? Those are the downside months for this pair in particular. That does not mean that in a certain year the pair could not rise, okay? But taking this time to make this kind of statistics for yourself for every single cross will be a great exercise. Most of these times of the year that we have not much to do, right? Market is not the most attractive thing these days with the lack of volume. Anyway, either way, the seasonality I'm talking about, dollar Japanese yen, okay? It's very strong and one that is worth keeping an eye on because during July, as I told you, the pair is mostly bullish, as well as in August, while it's pretty bearish during February and March. Okay, this kind of study, right? What is worth for us traders? It's worth because we could be favoring that side of the market particularly, okay, over that certain time period. Things happen for euro dollar, for example. I post here January for euro dollar because it's the most bearish month of the pair, right? If you take a look at this one, we have 11 years, and it has been a pretty bearish month for euro. January in January, okay? So it's like a tangle radar for me. It's not only euro, there are other pairs that tends to be bearish in January, Aussie dollar, New Zealand dollar. Those are the most bearish one over January. But take a look at yourself and tell me what you find out happened over the last 10 years. Anyway, the dollar market is one of the most liquid markets in the world, right? That's why it explains why most of the money ends there in the American market, right? And that's why we at the end, despite whatever happens, end buying dollar, right? Pound is also a very seasonality currency, okay? But for example, it has months. For September is a good month to trade this pound to the upside, for example. That kind of information, okay? Mix it up with the ones that we have already talked before, and mix it up with a bit of technical analysis. Even if you're a short-term trader, okay, that would be the basis for analysis, and that's what I do on a daily basis. At the end of the day, all the information I'm sharing today with you is the extra I add to my analysis, my technical analysis on a daily basis, okay? Despite this kind of seasonality in the forex market is rare, okay? Being aware of each of the months that certain pair tends to do certain things in the market, okay? It helps us to trade a lot. In these patterns won't always be repeated, as I told you, but being aware of these trends that can help forex traders to understand where the probabilities are. And that's what we are always looking out for here, probability. If there is a strong case of seasonality in a given month for a certain currency pair, it may help to support a trader idea of selling or buying such pair in that particular month, okay? Or in the contrary, avoid trading what we are seeing because it's against that. Anyway, I will turn that off. Okay. Okay. I'm here. I removed the camera a bit and I will be answering some questions. Okay. So let's start. Boyke says this, what are cycles affect forex? They affect me, you know. Right now we are getting into summer, so I'm getting a very bad mood because I hate heat and humidity in Buenos Aires. But, but, you mean seasons like incident, well, they don't affect the market. But, if Abel says, do you mean most January euro use will weaken? Yeah, there's a good chance of that, Abel. And mostly with all the other factors waiting also, with the fact that we have the financial crisis in there, with the fact that the world domestic product in the Eurozone is not that big. That all suggests the euro dollar will extend slide over January, okay? I do believe that, to be sure about what will happen with the growth, we need to wait till payrolls, the first Friday of January, okay? If payrolls show a bit of improvement in employment in greenback, then that will be a technical confirmation that the euro dollar will be probably on the bearish side most of January, okay? Jack says, what is the best indicator to find or measure cycles of euro dollar on daily charts? Jack, I don't know if indicator is the best way to measure in the long term, right? And that's what we are talking about. There's not a technical indicator, but a fundamental indicator, the one that I have been explaining, right? For daily charts, meaning for long term, weekly, it's better for that. But if you want to use an indicator for measuring cycles, use a slow stochastic, okay, oscillator with 80-20 levels. That could be for euro. And about if the euro is going to strengthen in March, March is not a good month to talk about seasonality, okay? It's a 50-50 month, so not much of that in there. And Pip Shaker says, so all this cycle analysis is just to give us market media. Yeah, that's the base of each Pip Shaker, okay? Okay, Pip Shaker says this is interest rate checks based on look at seasonality. Yeah, well, I believe that all the idea of trading, right, is based on concept that we are meant to forecast the future, right? So we can analyze what happened in the past and see the probabilities of such events repeating in the future, okay? If 80% of the last 10 January euro dollar falls, there's an 80% chance that euro dollar will fall next January, right? But it's not just that. We need a confirmation. So as I told you, watch the non-farm payrolls, okay, in January. Watch them. If the non-farm payrolls are slightly positive, or better than expected, or better than previous months, there's a good chance that 80% probabilities will increase and come into play, and the euro dollar will fall. Okay? If dollar found some support. We cannot use just one market factor to predict the future. We cannot just base, I will be selling euros because it usually in January falls. No, that's not the idea. We have that as one data. We have either dollar strength or dollar weakness, and the same for euro. Okay, yeah, I'm making a point. Sorry, Pip Shaker. I'm too excited today, I think so. Anyway, I was not trying to be aggressive, okay? Sorry, really, it sounds like that. But, well, that's the idea, okay? So, if we had those couple of factors, then, yeah, we have a good chance of succeed, okay? Anyway, if you don't have any more questions or comments, okay, I will say goodbye right now and tell you all to enjoy a great weekend. Surely I will, okay? And hopefully we will be seeing back on Sunday, right? With the live market opening at fxstreet.com. Okay, yeah, boy, I will enjoy the summer. I will be in the pool all weekend. Thank you all, guys. Really, my pleasure to be here with you, and hope to see you back soon, okay? Thank you. Yeah, Fernando, same for all of you. Merry Christmas to all of you. Enjoy your time with your family, okay? Hope so. Anyway, bye-bye.